And joining me on the podcast right now and in live full Technicolor, it's full-time investor equity analyst Paul Hill on Black Friday, and the market is having a sales day.
Yeah, there's only one colour on my screen at the moment, looking at the shares, and it's all red. Unfortunately, there's very little partying going on, but and that's just part and parcel of the actual market. You just got to be better to live through this sort of stuff. What's your sort of take on it so far?
My take is very oddly optimistic, and because the market's been really horrible since end of Q1 for small caps, micro caps generally. Everyone I speak to come on the podcast saying my stocks have gone nowhere. You've had a little few blips, but they've gone nowhere. It's been just grinding lower and lower, and just emotionally and mentally it's hard work. Now this gets me excited a little bit. This scariant that's come along. I know they're saying at the moment early data about 70 people they're saying I've got it. They've called it very early, which is very good, and I'm glad that they're shutting down travel from South Africa very quickly and all that stuff, so hopefully they contain it. But in my mind, you need this. Remember that we had the dash for cash crash back in March 2020, just went down as quick as the biggest, fastest sell-off ever, bounced back very quickly. But I think you need this kind of stimulus to bring people back into the market a little, because it's just been grinding lower for a long time. And we've had the hangover after the party last year. And I said previously, anyone could have made money in stocks if they'd started investing in April last year. And they could have doubled their money in the biggest dog. If you pick the biggest dog, you probably could double your money anyway. Pick the good stock, and you've done a lot more than that. This year, it's been too hard, too easy last year, too hard this year, and I think it'll revert to mean. But we need this kind of almost this rush of money out, money in, and I think that's what's going to happen. Hopefully, it will push the market a little bit higher in towards the end of the year. Once we get a bit more detail, because I say that because right now the market is pricing at ultimate fear. They're thinking this is the worst variant ever. We don't know much about it. So the more detail we get, the more data we get, I think, it may not be good, but it won't be as bad as what we're worrying about now. Everyone's thinking, that's it, that's the end, it's going to be worse than everything. It's probably not. We've got more tools now to tackle these variants than we had before, and more data. We know a lot more about them. So I think it's a large, scary jump of money out. Of course, market makers will mark everything down as well, scare people to sell, and they'll jump back in as soon as the rally happens. And there will be a rally, and then money, as we know, selling begets selling, as buying begets buying. So it'll start rallying, people start jumping back in. I think it's needed in an odd way to just shake the market over its malaise,
You raise excellent on the behavioural side, but let's just overlay that with a bit of science, shall we?
Don't do that.
I don't know.
All about behaviour.
You do the sentiment, which is great. Now, just in terms of the medical science, etc., what they seem to be able to get so far. I mean, you're right. It's early days. We don't know how sort of like what this virus is like, this variant, etc. But there's no doubt about it from the early PCR tests, and there's a great chart in the FD today. But it absolutely shows that it's far more contagious than either the beta or the delta variant. Just looking at the charts, it's just gone through the roof in terms of its potency. Now, we don't know how deadly it is in terms of if you actually get this, and it looks as though a lot of people are going to get it, then what's the chance of you rocking up into hospital? And then also how effective is it going to, how effective are the vaccine, the efficacy of the vaccines against this? And again, we don't know that, but I would say from anecdotal evidence so far is that because we've had quite a few PCR tests, we haven't seen an absolute moonshot in the number of hospitalizations. That doesn't mean people aren't suffering big time, but it probably suggests that it isn't absolutely horrendous. Now, that may well be that we're still a bit early, but it probably also means that some of the vaccines are actually working. Now, if that's the case, I mean, it will test the vaccines because this has got sort of like 30 or 32, I think it is, mutations around the spike protein. So it's pretty virulent, to say the least. But if it does hold on the actual vaccines, and the booster shots are coming in at probably about, they'll be up to speed to be able to tackle this in about 3 months' time. So my take on it is that, yes, there is a chance that we're going to have a bit more sort of social distancing. There is also a chance that we may well have less partying at Christmas, i.e. because it's a super spreader event, a bit like what's happening in Europe in terms of, closing some of the venues, etc. But when you put that all into the round and actually look at the market, it's come such a long way. A 3% fall today is not here nor there to a certain extent. And if we just push the recovery to the right by about 3 months until we get the booster shots, I'm actually with you. So when you put a bit of logic onto it, the central banks will continue doing the heavy lifting in terms of they won't start reducing tapering early. They'll just keep it going, or just stop it totally and just keep the asset purchases. Likewise, they won't push up interest rates massively. If they do it at all, they'll just delay and wait and see. And that'll then take us through, hopefully, until the spring when it gets a bit warmer. And I would also say we're not just the vaccines, we have these antivirals that I've talked about. And, I've invested in Merck, which is great. Pfizer's antiviral is just top drawer. And clearly, there's lots of generic manufacturers out there who will be pumping these tablets out. But equally, the other one I've invested in is AstraZeneca. And they've got an antibody cocktail that isn't basically intravenous injection. It's just a straight sort of like, it's injected like a vaccine. And that gives you 6 months protection, 83% efficacy. So when you look at it through that lens, we do have a lot of tools. My only problem I have is such that it's going to be the next 3 to 6 months, simply because the NHS and other health authorities around the world are so stretched. It'll either mean everybody who's got another condition like cancer and stuff is going to be delayed again, and with operations, which is just terrible, because we're going to see the continued increase in patients' waiting lists. So I think the government are going to basically will just take it as a watching brief to a certain extent, and it might well be that we work a bit more from home and stuff. But it won't the important bit is the medium term, it won't derail the recovery. And I'm with you. So when you put the behavioral finance stuff that you put on to the actual logic, it does suggest that actually this is a bit of a storm in the teacup. And it is obviously painful. If you're into sort of EasyJet, which is down 10%, if you're into AIG, which is down 11%, or the hotel chains, which are down 5%, or even some of the holiday sort of venues, it really is tough. But you've got to look at it, so they actually have come a long way. So yeah, I'm with you. I think we're actually Black Fridays. Is your description is very good, but I don't.
Well, do you know what? If you look at it on a practical level here, what's happening? It's been caught very early. I mean, amazingly, 70 cases. That's all they've got so far. Of course, there's going to be more than that, but we know it's there now. And so people are being monitored, and we have the tools now to monitor more quickly, and so we can isolate this. So if your investments are in the UK, which mine are pretty much, then we now can track and trace people very quickly. And if anything, talk about sentiment and behavior, it'll make people behave a bit more and think, hang on a sec, already in this country, we're starting to be a bit wary of the variant. So it'll make, hopefully, people will get their booster jabs a lot quicker. And also the mutations, I don't know if I'm true to say this, don't they happen because more in areas, in countries that have not been vaccinated that well or highly amount? So we need to get the vaccines out globally, and this will help that. So if anything, this will help the fight against it more. And like I said, we're on top of it. At the moment, there's no cases in the UK. Once there will be one, there'll be a bit of fear in the press. I guarantee there probably will be one, because people have been coming in hundreds from South Africa for the last 10 days. So there probably will be one, but at least then we'll know straight away, and we're looking for it, and it'll be traced and it'll be locked down. So we're in a better place now than we were back, in March 2020, but we didn't have, a vaccine and all that stuff. So pricing in fear.
A question I asked one of the fund managers at the start of the week, James Thorne, which was, I'll ask you as well. Are we going to get a Santa rally then?
I think, I was saying, it's been very bearish, and I think that is a good setup for a Santa Rally, because we know historic sentiment in the markets works is very strong, and even if you look at the chance of it happening, it's something like 60%, isn't it? Something ridiculous. So if you're a betting man and you're looking at stats and odds, you say yes, it's going to happen, especially if it hasn't rallied very quickly. The trouble is, the market is an odd market, isn't it? If you look at the US stocks, they're going gangbusters, which is nuts. You've got these EV plays that are like Rivian, which are worth more than sort of Volkswagen. They've sold not one car, and they're rallying like crazy. So it's very bifurcated. You're doing it, and yet over here, small caps, micro caps taking a battering. But remember, global fund managers are global, and they're looking at different markets and saying they might not go into the sort of small caps, micro caps, but they're looking at UK and saying, the UK is looking like, it's a good value play here, because we are seeing now we're going to get the fastest growth, amongst the G7 countries in this year, and yet the markets aren't showing that. So it'd be nice to get some liquidity into our markets, I think, which could happen. I mean, all we need is the tech bubble. So I don't think in this case, if the US markets, sneeze, it's necessarily will catch the cold here, because you may just see, a rotation of funds from the American markets, which are crazily valued, into the UK. Hopefully, I don't know. You never know what's going to happen. But Santa Rally, unless we get, if we get worse data on this variant, maybe not. But I think the more data we have, the more we know about it. So, and like I said, there's no cases in the UK yet. There probably will be a few, but as long as we know there are, and we have that information, that's good. The more information we have on this, the better. At the moment, we have very little information. Like I said, that chart, the guy from John Byrne Murdoch, excellent chartist from the FT, worth looking at. It does show that spike going up like crazy, the transmissibility of it. But remember, that's only 70 cases, and the others are based on thousands of cases. So even though it spikes very quickly, it's a bit of a misrepresentation. But yeah, I just think hopefully Santa Rally's happening. I'm hoping it will, because 2021's been a miserable year.
I think it's going to be more a dish of cold turkey myself by in the next 4 weeks. But hey, let's see. But equally, I think too. What I like about this, I mean, I think you and I have the same sort of view, etc. At least it sort of clears out some of the dead wood. The worst for sentiment and for you and me and for most investors is the death by 1,000 cuts, where it's gradual grind lower. If you actually take a sharp hit, it's painful at the time. But it resets expectations, it resets your portfolio. And I look at it such that, yes, I mean, I've actually had quite a good 2021. It's been soft over the last few months. November's obviously been tough, and I'm expecting that December to be tough as well. But if that means you have a good 2022, hey, I'll take it any day. So I've got no major problem with that. It just gives you, a chance. I think the key.
I keep saying to people about investing stuff, and there are businesses under these share prices, and if you are quite confident that your business that you invest in is going to get better, is growing, say more efficient, is going to generate more cash going forward over the next 1 to 3 years, and this is a blip. There's probably opportunity if you've got cash, and that's it. I mean, like I said, last year you could have picked any old stock and done well. I mean, next year I think we'll be revert to a little bit of mean, and it's more of a stock picker's market where you've got to pick a bit of quality, but you'll do well if you find that quality,
Yeah, but I think the key for investors at the moment is have a look at the portfolio. It's always good at the year end to sort of like run through what positions, what exposure you have, and to educate yourself. But absolutely don't throw the baby out with the bathwater. I think a lot has been done with that. Now, one stock, again, I want to pick your brains on, because I know you've spoken to the guys. Born entrepreneur, Mark Swinson, who's just IPO'd his business, Mark's Electrical, with an excellent CFO, Josh Egan. You've just interviewed them. I know it hasn't gone live yet. What's your view? What's your take on it?
Do you know what? I love Mark. My podcast asked them to give a quick summary of the business. And straight away, as Mark started talking, he's literally born salesman. I looked at, and he literally founded the business in 87, I think it was. And I said, do you know what, Mark, I can tell from your passion, you're an owner operator, and it's your business pretty much, and and you're taking people along the ride with you. I can tell that in there. And you just say, I said, thanks for coming on Black Friday, because it's probably a busy day. So it's been busy there. I think we're going to hit records already. We're knowing that. And like I said, their half interim results, they hit a record revenue.
Well, they had like revenue of 78%, 78%, industry leading EBITDA margins. And what it is just a massive sort of contrast with AO World, because Mark has absolutely, he's a bit of a visionary actually, because when I interviewed him earlier in the week, he recognized there was an opportunity at the start of the year, because he needed to have the correct sort of like level of delivery and logistics, as well as actually product availability. So he basically bought, he told me, 58 brand spanking new Mercedes delivery vans, and recruited a shed load of drivers for it. Plus Josh has basically pre-ordered a whole lot of stock as well. So they've got great availability heading into Christmas. Whereas AO World came out with a mere sort of like statement earlier in the week, really struggling to get product into demand. And what your observation that he's a born entrepreneur is absolutely perfect, because when I interviewed him, I said to him, my wife basically we've got a fridge freezer in the kitchen, and the handle on the ice box is just broken, so it doesn't work anymore. And he was automatically trying to sell me a fridge freezer, which was great. It was exactly the kind of thing.
Well, do you know what the thing is? They said, and I like this, and he said, I said, so how do you intend to keep the growth going? You know, how do you get this market share up? And he basically said, doing more what we do, but and he said, we are the best kept secret. So we have to just market ourselves, because once people start using us, they come back to us because we use all our own drivers, our customer service, you know, customer obsessed. That's what Jeff Bezos started doing with Amazon. You know, he said, you've got to be customer obsessed. And they are, like I said, their Trustpilot ratings are, you know, 5-star reviews. And he said, we use all our own delivery, next day delivery. We don't charge for that. And we're obsessed with that. And so it's just getting it right, isn't it? You know, if you get it right, your business right, like he's doing, you win customers, full stop. And that's, he said, all we need to do is raise our awareness, the brand awareness, you know, and the company awareness.
Yeah, so, and he's 100% online. So essentially, if we do go through a lockdown, his business is still going to operate. Nothing closes. In fact, if anything, it's just going to go through the roof again, you know. Yeah. And I'm with you. I mean, I think when they came out with their interims, their market share is about 1.5%. But Mark told me over 5-6 years, he wants to get it to 10%. And if he does that, using sort of like just a standard sort of 15 times EBITDA multiple and just existing sort of margins or 9%, etc., that would generate a valuation of around about £6.40 compared to the shares at 115p today. So if you're a long-term investor, again, I reiterate, don't throw the baby out with the bathwater there, because both of them are a great team. You know, you've got sort of like the heart and the passion and the sales acumen of Mark, and then you've got sort of like the financial genius of Josh on board. So and people are looking,
and people are looking for, like, you know, comparison. Oh, AOL's dipped, I may buy that. That's the wrong attitude to have. When you're investing, you want to invest in good businesses, improving businesses, you know. And like you can see that Mark's Electrical, his name is above the door there, you know. Mark's Electrical, he's doing it right. And so you invest in strong businesses, you know, market leading businesses, not the ones that have taken a massive dip because they've got weakness. That's not what you do. You look for the strong business, not the weak business. So no, I like them a lot. I think they'll do very well. It's just
another one which came out. I mean, I think I highlighted it to you about a month ago, and I said it was ridiculous. Another baby out the bathwater syndrome is Michelmersh Brick, because it's a stock that I've owned in the past. I don't own any at the moment, but you know, their shares have come down about 25% from 52-week highs, just on no news at all. And I remember talking to you about it about a month ago and just saying, look, I'm sure that these guys are ultra conservative, and I bet you, I know there's inflation fears on energy prices, I bet you they've hedged it forward. Anyway, they came out with a trading statement earlier this week and said that they've actually, you know, secured energy prices up and throughout the whole of 2022 into 2023. So they've got almost like copper bottomed sort of like profit margins into next year, because effectively the pricing environment for bricks is definitely firmer. You just look at the house builders, they're all doing fine. And the trading statement will say they're still seeing, they're doing better than expected trading in terms of new build housing, repair and maintenance, and infrastructure coming back. And if you look at the, you know, it's a great chart from, I think it's from the Office of National Statistics, breaks down the construction market. And it shows you how much infrastructure has just rocketed over the last 6 months. I mean, it's the last time I looked, if you indexed it back at January 2020, it's about a 40% higher than it was before, and that's driven by things like HS2 and lots of other big infrastructure projects. And they're going to supply a lot of the bricks into sort of like the stations. Plus you've got the cladding, plus you've got regeneration of shopping, you know, sort of high streets and stuff. These guys are in a perfect position, and they're really, really cautiously, you know, sort of like, you know, managed and run. And, you know, I tip the hat. So I would say, you know, don't throw the baby out of the bathwater. I mean, I can see, I think the shares are currently around about just below 130. I could see them doubling easily over the next 5 years, and that would not be a stretch at all. Because you know,
so where, and their market is, what is it? Is it all across the UK, or is it, where is it?
No, it's absolutely, they're a national distributor of sort of premium bricks, which are sort of like aesthetic, you know, better looking bricks, etc., for niche sort of like, you know, markets. They own about I think it's about 5% share of the actual, you know, sort of like sector. And but they also sell a bit into Belgium, where they bought a company there. But they've got the hardest bit they have is actually building sufficient stock to meet demand. And that's going to come through over the next 5 years through a combination of debottlenecking, improving sort of like their supply chain efficiency and productivity, but also probably a bit more M&A, because they've had a great track record in buying companies and integrating them. They currently trade at less than 8 times EBITDA, and this should be a 10 times EBITDA business. But I actually think the EBITDA on the estimates going forward are pretty light. I think they'll do better, because I can really see the brick market, staying strong, and it hasn't had the pricing come through yet, because a lot of them were sort of like on 12-month contracts or 6 months contracts. They haven't all rolled over, and you'll see a lot of that with the building materials. Certainly, it's been, the ones where it's more things like plasterboard, the prices have gone up quickly. But I think with bricks, you'll start seeing the real benefits next year. So again, do you think people
are getting confused? I mean, obviously the costs and all that stuff, getting confused with the housing market, because it's softening a bit, isn't it, after the stamp duty has come off. But I mean, of course, house building and all that stuff, we're always in deficit. We only need to build more houses, and all that stuff. So
the government's got a target of 300,000 new houses a year. It's promised that it's going to do that to the electorate, and we're only doing 200,000. So the secular drivers behind the market are massive. But let's be clear about it. That's only 50% of their business. Sorry, that's less than 50% of the business. The biggest part is repair, maintenance, and installation, because they have such niche bricks, etc. That's people sort of like wanting to do up their houses. And don't forget, there is still 150 billion pounds of savings in people's banks. I mean, just look at the fund managers, how much inflows they've had into their funds over the last 12 months. So 150 billion pounds, of extra deposits and savings that the consumers are going to spend, and they're going to do that next year. They're going to go to your escape hunt. They're going to go flipping, on holidays abroad. And they may even sort of like, go and support my football team, Warsaw FC, but I doubt it.
Yeah. I mean, do you know what? It's funny when you have, portfolio. If you can have a diversified portfolio sector-wise, when you have worries like this, of course you're probably gonna have 1 or 2 stocks that are going to take a hit bigger than other stocks. But again, you got to, like I said, look through that, haven't you? I mean, not just think about the next month or 2 months. Think about the next 12 months to 3 years. Like I said, in fact, you mentioned escape on there, and it's taken a knock today in the share price. The thing is, they've got plenty of cash. They just raised a lot of cash, a chunk, close to 10 million. And how long is this scary atmosphere going to be around for? Not that long. It's like, and I suppose the worrying thing is, if you are, I mean, someone did say actually on the chat group of my investment clubs, the thing is, some companies, the bigger companies with lots of debt now, couldn't handle another lockdown, or they'd struggle because they're taking on more debt. So these bigger companies are more of a worry than a smaller company with just lots of cash and no debt. So debt is the worry, isn't it? If we do go into lockdown, but I suppose if you look at, for example, escape until last lockdown, they benefited hugely. They obviously the costs went down massively. They had furlough, they had lots of bounce back loans. They also increased their estate from 9 to about 19 sites, because commercial landlords were looking for tenants, so they sort of benefited from that, and that's a sign of good management. So I'm not too worried. They've got the cash. They can handle a lockdown. It won't hurt them that much. But I mean,
they were recommended, weren't they? They were just recommended in the Daily Mail. Was it the Midas?
Daily Mail, yeah, like Joanna Hart, yeah. I used to have Joanna Hart. She appeared on the podcast a few times years back. I should get her back on. But yeah, they're recommended there. I like to say their earnings will go from just this year from off the top of my head, 1.2 EBITDA. This is 5.7 next year to 9.4 the year after, forecasted on the sites. So it's really good growth there. But yeah, I mean, a temporary blip. To me, like it's a Black Friday deal here on some. But the debt side of it, those bigger companies like I don't know who they are, but the IAGs, the world, and maybe not those. But is that a worry? Do you think if they on those companies there, because the flying, of course, has been stopped already from South Africa? Is that a worry for that those kind of the debt they have?
Not really. No, I don't think so. They'll just basically refinance, because I think people have got so much money swimming around that the people who will benefit are the banks, the corporate finances, and the fundraisers, because they'll have another sort of field day for anybody who's got sort of too much debt, and it'll carry on. They'll carry on issuing equity and debt finance and stuff. So we've seen this movie before. What happens is that basically you think it's going to be a problem, but actually, by hook or by crook, somewhere along the line, you get it sorted. But I mean, I personally wouldn't be. I haven't got any bank. I haven't got any airlines or leisure stocks or this sort of stuff. But if you're a large company with a big brand, you're probably all right. So you may take a bit of a hit because you have to raise more money, but I don't think it's going to be absolutely nuclear anyway. Because
and in fact, you know what I said, because of this last year as well, apart from expanding the physical estate, Escape had started their digital VR experience for corporates. And last year they did a one single game. They did 300 people in one single game. This is international business, very well-known business, and the cost of that are minimal, because you've got, rather than having that 300 people would take up most of their physical site, but they did it in one game with about 2 or 3 games masters, which normally the guys in charge of that games masters probably have 10 times that many, to physically look after that. And it's happening again this year. I just saw on LinkedIn, one of the guys in charge of that, this big group said, can we do it again this year? So over 300 people doing the VR game, and maybe more of that will happen, because people are worried about the scary and the variants coming out. Maybe more of that will happen. So they've got another part of the business as well. But do you know what, stats? It's very odd that knowing what we know now. I remember when AstraZeneca first came out, there was like talk that efficacy is around about less than 70%, and that now they're showing it's probably better than the other, vaccines.
The T cells, immunity,
So things change, and like I said, we know now they're saying, it could reduce vaccines to 30% of efficacy, but that's early stage. We don't know yet. It could be way above that. So
I actually don't think it's going to, totally reduce the efficacy and the effectiveness of the vaccine, simply because we would have probably already seen that. If it'd been absolutely horrendous because of how contagious this new variant is, anecdotal, we have probably seen it. So I'm less worried about how deadly. I am contagiousness. It's absolutely just gone through the roof, no doubt about it. But in terms of how serious it is, we'll wait and see. But anyway, another one which is don't throw the baby out with the bathwater is Revolution Beauty. I mean, they IPO'd sometime in the summer at 160p, but the shares are down now to roughly £1.30, and they came out with absolutely fabulous numbers this week, with basically EBITDA and like-for-like sales up 39%, and they've basically just had. There was just, I interviewed the CEO and the founder, who's brilliant, Adam Minto, and the CFO Andrew Clark. Earlier in the week, and I strongly recommend people have a look at that video because it just says everything. But anyway, coming into the second half, how's actual trading after a really good first half? Well, I use the pun, they had a monster Halloween, and Black Friday is going to be huge. And guess how many pounds worth of Christmas beauty advent calendars they reckon they're going to sell?
How many pounds worth? Well,
just to say, I thought advent calendars were chocolates.
Yeah.
But now they do a range where they sell, obviously cosmetics behind each door.
So I'm going to say £1 million.
12 million quid's worth of beauty advent calendars.
Really?
I know, yeah, absolutely colossal. That's just them. So they're absolutely doing the really, really well. And what's fabulous about the actual brand, etc., is it's really becoming sort of like a must-have or must-own brand in major sort of like good, well thought about stores. So the likes of basically Ultra Beauty and Target out in the States, Boots here, and Superdrug in the UK. I mean, it's drawing their customers into the stores, those retailers' customers into the stores to basically shop for Revolution Beauty cosmetics, hair care, and skincare. And that seems to be their brand just is resonating perfectly with particularly the younger demographic of consumers. So much so that not only, they've got thousands of sort of like stores that they they're actually into, but so much so another massive retailer out in the States has just signed up sort of 2,800 stores to take Revolution Beauty cosmetics as well. So what's that saying is that the momentum and the sort of the viral promotion and support they have through consumers and demand is forcing the distribution channel to take Revolution, beauty products, etc. Which is, so you're going to get that demand pull. Plus, obviously, you're getting their, they're best in class when it comes to sort of like digital sort of advertising and endorsers, and also sort of like doing that innovation cycle. I mean, that's probably their strongest USP. They can turn around new products and successful new products in a much quicker time span than any of the big brands like L'Oreal or Revlon or people like that. So they reduce the risk not only to them of a successful cosmetic, but also to their retailers. And as I say, consumers absolutely love it, but they're still only scratching the surface. I mean, the actual direction of travel or the opportunity is huge. They should do roughly just south of 200 million in turnover for the year end February 2022. But this could easily be, 500 million, £1 billion business in the next 5 years. Because I mean, Adam is so passionate about the business. I mean, he's like Mark. I mean, they founded the business. They love it. They've made enough money. They could walk away anytime, but they don't want to because they love it. And it's like Soup Chandal of Cake Box. They're so into delighting the customers and having an excellent product, an excellent experience. That just keeps them motivated and keeps them young, and they just get so much joy out of it that you can just see it through the products and through the actual business. So again, I'd say, don't throw the baby out with the bathwater, because that's an excellent business.
Do you know what? That book, it's probably worth reading. Though, look at companies that did 100 baggers, and you couldn't predict any of them. They try to come up with these, traits that these companies have. They said not a lot of traits they have in common because they're all different. He said one of the traits that quite a few of them had, though, was they are founder operator companies, owner companies, and so because it's the passion and drive behind them, and they know the business inside out. It's not just a manager brought in to look after the business, and they have and they all hold a decent bit of stock and skin in the game, and they love it, and in fact I saw that sale this week of Soup Chandal sort of in Cake Box selling that, and I thought, well done, he's worked his backside off, and obviously he holds a big chunk of shares, so he offloaded some, and I don't see that, in my way. I think I applaud people like that, absolutely, and thinking, it's nice to see actually, that's what you're in the business for, is to make money, of course, please your customers.
I mean, to be honest, I think the background to that is the fund managers wanted some more, some stock, and it was just to improve the liquidity. So I think he basically just said, well, okay, it helps the fund managers off to be able to do it. So let's give them some more. Let's give them some stock because they want more and the demand is strong. So why not?
Yeah. But some people may see that as a negative. It's not a negative at all. It's like and that's a real thing. When you have a big holder of that, there is lack of liquidity. But also, I think it's nice for him to cash out a little because he still holds a big chunk of shares, doesn't he?
Yeah, I think it's over 20%. Yeah,
24%. I think it was.
Yeah, 24 was rung the bell. Yeah. I had another. I had one of the stocks I own. I had a Polarian imaging moment last week,
really?
Which was not quite. It was Amryt Pharma. I have a big chunk in there, and it's taken a bit of a hit. About 20% this week. Largely two things. It's decided to delist its shares on AIM and concentrate on NASDAQ, which unnerved a few investors, but should be sort of like fairly easy and just standard stuff. I mean, I've already contacted my brokers who own the AIM shares in Amryt Pharma, and it seems to be pretty much sort of like bread and butter stuff just to convert them into ADSs, which are traded on NASDAQ, which are existing. So I don't think there's going to be a major issue. And then the bigger news was on the following day, on the Tuesday, and they said that the FDA had delayed the decision on whether their oleo gel to treat EB, with that approval would be delayed. Would be delayed for 3 months. So rather than the 30th of November, which was the date that was supposed to be, they've actually done it for the 28th of February. So that's sort of taken some juice off the shares. But I would say there's a couple of positives out of it. To a certain extent, it does seem as though they're in good communication with the FDA, which is great in terms of, that they want to actually get it sorted. The FDA, as you know from Polarian, is massively busy because on the 30th of November, I know certainly they've got a mountain of approvals to get through, one being whether to authorize Merck's antiviral, because that's got to be approved, and there's lots of others. So you can understand they're a bit sort of like bit swamped, and they said they wanted some more information, and I don't know, but I'm suspecting the information is just to do with how, sort of what the application, what therapeutic areas it goes into, what the label is for that particular, for the oleo gel. And I'm hoping that obviously they comes through with approval in at the back end of February. In the meantime, though, the European Medical Agency, which is the equivalent to the FDA in Europe, they're approving, or hopefully approving, the cream and the treatment. I think it's by the end of January, and so sort of 3 to 6 months, we should be able to see how that particular product. But even if you strip that out and you do the numbers, from, as I say before, I think this business will do $300 million of turnover without oleo gel in about 2 years' time. And if you do that on a sort of 25% EBITDA margin, stripping out the R&D that they need to spend and launch costs, etc., for the oleo gel, but the R&D for the existing pipeline, then effectively you get the share price more than underpinned just by the existing business. So you get the pipeline and oleo gel in for free. Only time will tell, but it's one of those things.
Do you know what the thing is? Like I said, in future, I'm going to avoid binary plays where it's involving a regulatory body in some way, because especially if that's the only play the company's got. And I mean, with Amryt, it's not. They've got other arms and legs happening there. Because it's because. Whether the brokers say it's 90% chance or not, there's always a chance, and if that chance happens, goes the wrong way, like say you get a drop of 50% in the share price, so it's basically worth avoiding that, or even reducing their amount. So in future I'll be doing that. In fact, I've got a sort of binary play of sorts, and I usually know with Trufin, but the thing is, they've got 4 parts of the business, and so the one part is Citago, and in fact Oxygen and PlayStack are doing very well as well. But Oxygen, sort of Stargo, of course, because I deal with Lloyds coming up. Now, I did some looking around, investigating, and if you look on Lloyds' invoicing finance website, it's exactly the same as Trufin's, Stargo's.
Yes.
I mean, and T's and C's, Stargo's mentioned all over it and all that, and we have the results of that coming up on the 10th of December, whether Lloyds are going about the commercial agreement, because it's been 12 months now trialing this. But literally, you can just dig through the paperwork, T's and C's, they're all over it. And in fact, the guys, they're quite confident that it'll happen. It's just when, companies like Lloyds, so big, it takes so long to do things. And I suppose it's in the FDA, is so big, it takes so long to do things. You can't, and sometimes the last time there's a delay, it's supposed to happen 6 months trial, but it didn't, but 12 months because they're just doing more work with it. And that sometimes happens, isn't it? You get timelines pushed out. Doesn't mean it's not going to happen. It just means some people are not patient enough to hang in there. There's a bit of the soul last time. So,
That sounds familiar. Not patient enough.
Yeah, well, I've been very patient of that. I still hold the stocks I hold. I mean, sometimes I did reduce in play, and after it bounced back up, I reduced a bit. So I still believe that the huge market there and the potential, but I don't want to be face on to that FDA approval type thing again. So I'm going to step back a little bit.
A couple of, I mean, just on that Lloyds, I've actually sold my Lloyds shares last week, and
you're selling more than me. You're like a trader now, to me.
I mean, as I said, I mean, basically, it was always a value play. It wasn't a long-term holding, that and Aviva. So I sort of like just took. Not that I've got any negative against the business, because I think they're both going to do well going forward, and they're still relatively cheap. But yeah, I basically just banked some profits, put the cash on the balance sheet, and we'll look to redeploy the funds over the coming months, probably somewhere in tech and software, or more into healthcare, because I like the pricing power, the IPR sort of heavy industries, and sort of like and do that. But I've got a bit of time, etc. But as I say, I just rang the register. I still think they're undervalued. I still believe, Aviva can go well above £4.50, and it's currently trading at today roughly around about 380, given the sell-off. And I still think Lloyds will track towards net tangible book, which will be 55 to 60p over the next 12 months, and it's currently 47. So there's still plenty of opportunity there, and they're both paying very, very good dividends. So it was grudgingly that I sold, but I just said, all right, okay, let's ring the register and let's ring the let's look.
It's good to have some cash, because like today, for example, it's like this volatility may go on for a little while, because they reckon 3 weeks. I mean, I can't see it. You probably get more data before that. 3 weeks until they get proper more data on the variant. So you may have, that buying window will be around for 3 weeks for you, and you've still got you've got plenty of cash there. So that's nice to have the cash.
I haven't got that. I mean, it's about 17%. I think it is. I'll just tell you how much it is. Yeah, I've got 17% of my portfolio into cash. Probably slightly higher, because I haven't readjusted my share prices of the other ones recently, and a lot of them have come down. So it's probably slightly higher. But yeah, I've got a bit of capacity to be able to do it. I'm not going to bolt it in at the moment. I mean, I've been so busy of late anyway. I want to sort of like a considered view, but as I say, I'm looking for baby in the bathwater where people have actually sold these things out. I'm going to pick them up, no doubt about it. Another one which is in my portfolio that came out with a good, and I know you'd say it's a boring stock, but maybe it is, but I love it, is Sage. They came out with some prelims 2 weeks ago, and they upgraded their estimates for next year. They reckon organic growth is going to be 6 to 7%. Hopefully they'll beat that, on top line. And they're seeing, as I said, they thought they would do. They're seeing increasing digitization and move to the cloud of small businesses. All their payroll, HR, and accounting software, because that's been the sort of the second wave of that whole digitization process from your front office into your back office systems. And their competitors are seeing the same. Intuit, which is QuickBooks, that one of their big rivals out in the States, came out with blockbuster numbers as well. So I'm very positive about Sage, and I pushed up my fair value up to £8.30 just on the back of that, and I still don't think that is particularly expensive either. That's based on 5 times EV sales, which I think they could actually get a better rating than that, particularly if they can tick up that organic growth. So yeah, very happy, fairly solid type of business, So
yeah. Well, listen, I given the last sort of 8 months I've had, I wouldn't mind a boring stock now. Just
buy a few boring stocks. Unfortunately, the boring ones are they're sort of like they haven't really come down a great deal. Another one which came out with some good news, and you talk about sort of FDA approvals. It wasn't quite an FDA approval, but it was similar. Was Lunglife AI 2 weeks ago. They've got basically they've got a laboratory testing. They do, as people probably remember, they do early stage lung cancer tests using really leading edge or cutting edge technology, which is CTCs, circulating tumor cells, to identify whether a patient has got early stage lung cancer. And they need to do some validation test over the next year or so. First sales, I think, are 2023, I believe, something around that. But anyway, their laboratory got basically approval from really one of the most stringent cancer testing organizations in the world, which is the College of American Pathologists. And because it's such a high level of authorization, that gives them automatic approval for the whole insurance system, or just about most of the insurance system in the States, the Medicare and Medicaid, which is great. So that's a tick in the box for their commercialization strategy. Verici had a similar sort of thing a few months back, but once you get those sort of like, stamps of approval by world recognized industry bodies, it just gives you that much more credibility in terms of getting those tests into to market to commercialize it. So they're tracking the right approach. And just to let people know, if you remember, just to give an indication, their CTC blood test has got basically 90% or 89% positive predictive value. So it's very, very it's confirmed in their validation test. It's very, very accurate. And just to give you an indication of scale, I mean, I estimate if they get about 5% of that market, then you could see the shares heading to 20 quid because it'll be huge, EBITDA drop through. So plenty of opportunity there for the long term, which is obviously pretty good.
Verici, and now because of these guys, Verici and Lunglife, do they have to go through FDA approvals and all that stuff, or not? Or
I think Lunglife are planning to go through. They're going to get FDA approval, but I don't think Verici are. I'd have to double check. I don't know exactly. But the point is such that once you've got the validation test, given that these are urgent needs, they should be okay. I mean, you're right. Nobody knows about the FDA or other approvals, etc. But I think what's happened is there's just the FDA is obviously snowed under at the moment.
They are. Yeah, no, Richard, CEO from Valerian, said that they're incredibly busy, and so literally, if they have any queries, they don't go back and forth with dialogue. They haven't got time for that. They just knock it. They'll say, "No, listen, get back to us," and and you have to take 30 days to even get a meeting with them. Just chat about it. So they moved on to something else. But I'm watching. Just finished watching Goliath on Amazon Prime with Billy Bob Thornton. He's a lawyer, and he takes these big corporations to court. And there's a lot of people say that there's a lot of chat with the FDA in there. Basically, they're saying that they pay the FDA, the big corporations, to get their stuff through. And I mean, you said before, and these big pharma companies have a lot of power with the FDA. I don't know if that's true, but
even big pharma struggle. Yeah. AstraZeneca hasn't even got their vaccine
approved. That's nuts, isn't it? And that is crazy.
Yeah, crazy.
Because it's based in the I think the French minister was saying that Britain tucked him up on the AstraZeneca because the French came out with their vaccine, didn't really work. AstraZeneca did very well, and he said and the Europeans chose not to take the AstraZeneca vaccine, but now AstraZeneca is looking like the one that gives longer lasting effect to the T cells, and yet it's not approved in the US. Doesn't make any sense.
A couple of interesting facts and just sort of like things to watch for investors is first of all Saietta, which basically does the axial flux electric motors, for 2 or 3 wheelers and other electric vehicles, outboard motors, etc. Well, in that industry, the M&A activity is definitely accelerating because after Mercedes bought out one of Saietta's competitors, it based actually in Oxford, similarly, Yassa. Well, Renault took a 21% stake in a French one called Wilo this week. So lots and lots of M&A going off in that particular area. So keep your eye on that particular sector. Another one was Equals, which is the B2B payments business that I own shares in, and their biggest shareholder, Crystal Amber, came out with its AGM statement and was saying basically that it sees increasing M&A in that particular sector, and it believes that Equals is going to play a part in that, whatever that means. So interesting. As I say, when you look at it through, obviously it's a painful day for most investors, no doubt about it. But when you look at it through, actually it resets the bar. You look through into 2022, you could set yourself up for a good year. I mean, I remember 12 months ago, I was saying to you, look, 2020 hasn't been a great year for me, but I'm really positive about 2021, and that's how it sort of transpired. So if you get a bit of pain now, then you appreciate the good times even more in over the next 12 months or 2 years or so. So
I mean, exactly. There's no point. It's easy to take a knock from this. Like I said, my stocks are down today, and they've been down pretty much hard work for the last 8 months. But and I said, if you can take a positive, and it is, your stocks become more attractive on a valuation basis than if they're going to achieve the goals they've set out, and that brings new money into the stock, because there are plenty of people out there who are clever enough to work this out and think, okay, so it brings new money in, and if they do hit those targets these companies have set, these forecasts, then they'll have a good rally. But you just have to wait. No one can predict the market. There's always opportunities. There's always sale days like this that happens, and if you've got cash, you can take advantage, and that's the way the market works. Sometimes it needs a bit of a sell-off to get the money inflow come back in, a bit of a bounce. If you have a bounce, money will chase the buy. Buying begets buying, doesn't it? Like selling begets selling. So we need this. Cool. Anything else, fella?
No, that's great. Love it. So I'll speak to you in a couple of weeks. I think you're going on holiday, aren't you?
I don't know if we are now. That's the thing. It's like
okay, you can't. Where are you supposed to be going to?
We're supposed to go to the Dominican Republic, so because we went a couple of years ago, really enjoyed it, and so
the West Indies, is it? The Dominican Republic?
Well, the Caribbean, yeah. So but at the moment we don't know what if they shut down all their. Who knows what will go on the red list next? So I don't know. Who knows? I've been exercising more than average, eating less to get into my sort of my Speedos shape, and I don't know if it's going to happen now.
Don't send a picture of that, please, Justin. No, you're just scaring a lot of people.
I won't put that in the video. Right, marvelous, Paul. Until we speak next time.
Yeah, speak to you in a fortnight. Cheers, Justin.